Hello, my name is Natalie Domingue, and I'm the Financial Literacy Program Coordinator at Atwater Library and Computer Center. The Atwater Library Financial Literacy Program is made possible through a grant from Canadian Heritage. Today I'm joined with financial planner Lynn Bennett, and the purpose of this information session is to compare the differences and similarities between tax-free savings accounts versus registered retirement savings plans. What are they? How are they different? How do I use them? How are they taxed differently? We have so many questions. Lynn, finally, how are they used? Can you clarify?
Well, I certainly hope so. Hello, everyone. Glad to be joining Atwater Library again today for their financial literacy program. So yes, we're going to talk about TFSAs and RRSPs. Just a little reminder, this is an information session only, so it is not advice for your own personal situation. If you do need professional advice, please contact the right person for that, whether it's an accountant or a planner or a notary. So today is for your information only. So TFSAs versus RRSPs.
What is a tax-free savings account and what is a registered retirement savings plan?
Okay, so they're both registered accounts, meaning that they're legislated by and regulated by the federal government. The TFSA offers you tax-free investing, and the RRSP is basically designed for retirement saving. So they are really, really similar in a lot of ways. So they're both a kind of umbrella account that you hold investments inside, and they tax shelter those investments as long as they're inside the account, inside that umbrella of shelter. On the TFSA side, it's the investment earnings that are tax sheltered, and on the RSP side, it's both your income that you put inside it and the investment earnings that are tax sheltered. So where do you open these accounts? At any bank, most insurance companies, there are investment firms, there are online investing firms, and even some employers offer TFSAs and RSPs as part of your workplace package. What investments can you hold inside of these two types of accounts? Basically, it's just about anything, and it's identical for either, except on the TFSA side, you can't hold those tax incentive labor funds, so not in a TFSA. But apart from that, you can hold stocks, bonds, mutual funds, GICs, cash, ETFs, just about any sort of investment inside either of these accounts.
So what are RRSPs and TFSAs used for, Lynn?
So as a purpose, the TFSA, because of its tax treatment and because of its accessibility to just about anyone, it's a great vehicle for either savings or investments. So some people use them for gathering up an emergency fund for unexpected expenses that may come up, or it can also be used for accumulating funds for a down payment for a home. That's a really good use for a TFSA. You can also use it as a savings vehicle if you're planning for a big travel project or just about any project. But don't forget, it's also can be an integral part of a retirement plan. Whether you are planning for a retirement in the future or if you're already retired. And I'll talk a little bit more about that in a moment. On the RRSP side, it really is designed for long-term retirement savings. And it's an account that was created by the government to encourage people to save for their own retirement. The idea is to encourage people to be able to supplement the government benefits that are available at retirement with their own retirement nest egg. And the way that encouragement manifests itself is in the retirement, the savings that you make on your taxes by Particularly when in your high income years, you can save on your tax bill during those working years. So it's saving for your retirement using a really tax efficient vehicle for most people, and by reducing your tax bill now so that you can save that money for later when you're retired.
All right, so how are they different?
Okay, so first we'll just talk a little bit about how they're different on eligibility, on the eligibility side. So the TFSA is very accessible. Basically, there's a minimum age of 18, but there's no maximum age. So just about anyone can have a TFSA. The same annual contribution limit is available for anyone. So it's just a figure that the government decides every year, and it's available to everyone. The contribution room that the government legislates accumulates over time if you don't use it. So whatever limit is available this year, if you don't use it, you can use it next year or the year after, no expiry date. One difference is there aren't spousal TFSAs. So you could make a cash gift to a spouse to open a TFSA, but you can't actually create a spousal TFSA. On the RSP side, there's no minimum age. So it's kind of the contrary. There's no minimum age for an RSP. Even a teenager could open an RSP as long as they had contribution room from income. But there is a maximum age of 71. So you can't have an RSP after 71. And the contribution room is not the same for everyone. It's really an individual thing, and it must be earned based on your earnings from the previous year. It also accumulates. If you don't use the contribution room, it accumulates over time. You have to use it up by 71 unless you can use up your room in a spousal RSP. And as we said, those spousal RSPs are available and can be used for an RSP.
How are they taxed?
Okay, the big question, taxes. So this is where we see some really major differences. Again, because the TFSA has no tax implications whatsoever, there's no tax to pay, neither on any of the income that you make inside your account. There are no tax forms, so the bank won't be sending you a T5 for your TFSA, no tax forms. And there's no reporting on your tax return for TFSA. You have to respect the contribution limits, but there's no tax reporting. The big difference is that the contributions that you make to a TFSA are not tax deductible. They're after tax dollars. But once your funds are inside that account, they're forevermore tax-free, whether that be dividend gains or capital gains or interest that you earn inside the account, completely tax-free. On the RSP side, of course, as we know, there are tax forms for both ins and outs. So when you contribute or when you withdraw, you will receive a tax form for each of these transactions from your financial institution, and it must be reported on your tax return. Your RSP transactions are reported. The difference for the contributions are that they are tax deductible. So any funds you put inside an RSP are subtracted from your income for the year that you deduct them, and that reduces your taxes for that year. Those taxes, however, don't go away. We're not talking tax-free here. The tax deduction that you get from the contribution is deferred. So what happens is when you make the withdrawal, it's then that you pay your income taxes on those contributions and on any returns you've made in the account. So TFSA, completely tax-free, RRSP, tax deferred. Tax deduction now, pay taxes later.
How much may I contribute?
This is also a good question. So as I mentioned earlier, the TFSA is very accessible. It's basically for everyone. The RRSP contribution limits, it entirely depends on your earnings, and what you can contribute is an individual amount. It's calculated for each individual. So let's kind of just look at a bit of the history of the TFSA. It was created in 2009. It's basically a gift from the government. There is not much in life that is tax-free. So when it was created in 2009, the annual contribution limit was fixed at $5,000 per year, and that was held at that level until 2013 when it went up. And then again in 2015, it went up again. And then in 2016, it went down again. And since 2019, it is at $6,000 a year. So if you've never contributed to a TFSA and you were at least 18 in 2009, at the moment, the cumulated contribution limit for a TFSA is up to $69,500. And that's for anyone. It's the same number for anyone. So any contributions that you've made would be subtracted from that cumulated limit, of course. But if you've never contributed, this is really a great vehicle. You can put a fair bit of money in there and enjoy tax-free returns. The RSP, as I mentioned, completely dependent on your earnings over the years. So you are allowed to contribute to an RSP and deduct from your income the lesser of each year's 18% earned income. So this year, for instance, a taxpayer would be allowed to contribute 18% of their earned income of last year and any contribution room that was calculated in the previous year. So the maximum in 2020 that someone could contribute was about $27,000. So, and the cumulated total would be, it depends. It depends on what your earnings have been over time and how much you've contributed. Just a little note, if you're also contributing to an employer pension plan, that also becomes a considered contribution room. And so it would be subtracted from your RSP contribution room. So it kind of all goes into that same calculation.
So how do withdrawals work?
Okay, so on both the TFSA and the RSP side, you can withdraw any amount at any time. It's just that for a TFSA, any withdrawal you make, it does not cause a tax event. There is no tax to pay when you withdraw money. And the other big difference is a TFSA, if you do withdraw something, the amount of that withdrawal gets added to your contribution room the following year. Not this year, but the following year. So what that means is you can, in effect, recontribute withdrawn amounts next year or any subsequent year. On the RSP side, as we said, there's nothing to prevent you from withdrawing any amount at any time. It's just that it's fully taxed as income when you make a withdrawal, and taxes will be withheld at source by your financial institution. They must withhold the taxes. It's like a down payment on your tax bill at the end of the year. So the note to keep in mind here is that unlike the TFSA, you cannot recontribute those withdrawn amounts to your RSP. Basically, that contribution room, when you withdraw, is lost in most cases. There are two exceptions, and those are those special cases where you are withdrawing from your RSP to purchase a first home, or if you are financing post-secondary education. And those withdrawals are sort of considered loans from your RSP, and you have to pay them back into your RSP.
Okay, so how do we choose? Tax-free savings account or registered retirement savings plans?
Well, this is a great question. So which do we use? Clearly, because of its accessibility and flexibility, the TFSA is great for short-term savings and investing. As I was saying earlier, planning for a particular project that's coming up, like a purchase of a home or a large item or planning for a trip, that type of thing. It's particularly useful if you're using it as an investment vehicle, it's particularly useful in lower income years. And this could be at the beginning of your career. When you're starting out, your salary is not as high as it probably will be later, and saving taxes is probably not your priority. It's good to favor the TFSA over the RRSP in this instance, and save your RRSP contribution room for later on when you'll be in your higher income earning years. So great for low income and for people starting out in their career. Also really good if your RSP is already full, you have no more contribution room on your RSP side, or if you're close to retirement and so you don't have that long-term horizon in front of you anymore and you're looking more at short-term investing, the TFSA then also becomes useful. And definitely if you're over 71 and you can no longer use that RSP as an investment vehicle, so then the TFSA comes in and is a great vehicle for that. I want to emphasize again, there is no maximum age for a TFSA. I think a lot of people might think it's similar to an RSP in that way and cuts off at 71. It does not. There is no maximum age for a TFSA. So if you are retired or if you are over 71, or in those years when you want to stay invested, you want to keep your retirement nest egg invested, you can keep your investments inside the TFSA and they're tax-free going forward. The RSP, as I said, it is basically designed for long-term retirement savings. That's what the government set it up for. And it's particularly useful, again, for in your higher income years where you're maximizing that tax deduction when you're in those higher tax brackets. Really useful for that. It's really also useful for people who perhaps don't have access to a lot of tax credits and deductions to get their tax bill down. And as an example, for instance, a single person who's making a good salary and has no children probably doesn't have access to a lot of tax deductions and credits. So the RSP becomes one of the few things you can use to really get your tax bill down in those higher income earning years.
So let's consider tax rate at the time of withdrawal versus tax rate at the time of contribution.
So this is another factor to look at when you're trying to decide how to divvy up your investment funds between TFSAs and RSPs. Basically, for most people, your tax rate when you contribute into an investment fund, a registered investment fund, for most people, you're taxed at a higher rate during your working years than you will be during your retirement years. So let's have a look a little more in detail. So if you are in that case where your tax rate now, while you're contributing, is going to be greater than your tax rate at withdrawal, for instance, during retirement, in that case, the RSP becomes the more tax efficient vehicle. It's designed for that, in effect. If, however, you're in the situation where you're in a lower tax bracket now than you will be later on when you want to withdraw, usually at retirement, then the TFSA becomes more tax efficient. What we're thinking of here are people who are in a lower income brackets during the duration of their working years, or it could also apply to people who have very generous employer pension plans, and that could push them into higher tax brackets at retirement, especially when the government benefits start arriving. So there are people in that situation, and for some cases, the TFSA would be more tax efficient. If these tax rates are, you believe they'll probably be equivalent, contribution time or withdrawal time, basically each of these accounts would be equally tax efficient as a vehicle for investing. So just a little recap. These two registered accounts are similar in some ways, but also very different. So the idea is to tailor your usage of these accounts based on where you are in the life cycle, what your financial priorities are. Are you trying to save for a house? Are you trying to save for retirement? and of course what your tax profile is, how much taxes you pay now versus later, or what your priorities are based on taxes as well. So similar, different, you just have to look at what you want to use those for. Ideally, you would be contributing the maximum you can every year to both of these accounts, but if you can't do that, you tailor your usage based on these.
That's great. So certainly you've clarified some questions that I know a lot of our viewers had. And if you're watching and you have more questions that need to be clarified, you can call us at Atwater Library, this number you see on the screen, and we'll do our very best to answer your questions or point you in the right direction. Lynn, thank you so much for being here today.
My pleasure.
Yes, you're always really good at explaining all these things, and we appreciate it. Thank you, everyone, for watching. Stay tuned, stay in touch, and once again, thank you to the Government of Canada. Have a nice day.
Thank you.